Welcome back to Beyond the 529. In today's video, I'm going to cover the main types of student loans that are available and what you need to know about each to minimize your student's debt and lower your family's cost of college. I'm Mike Bink, founder and president of Equivest Financial Advisors. I've helped hundreds of families throughout the country develop strategies to win the game of paying for college. I can help your student pick the right schools to get as much free money as possible, maximize your family's finances to get more financial aid and scholarships, minimize your student loan debt by picking the right student loans, and pay for college as efficiently as possible to lower your costs by thousands of dollars, all while protecting your family's retirement. If you'd like to learn more about how we can help you develop a plan to implement strategies like this, please click the link in the description below to learn how you can become our client. So today I'm going to cover the three primary types of student loans that are available. Type number one, and the most common type, is what's called the Federal Direct Stafford Student Loan. This loan is available without any qualifications to every student that fills out their FAFSA, or the Free Application for Federal Student Aid, and comes in two primary forms. The first form is what's called subsidized, and that's based on whether or not your student has need at a particular school. A subsidized loan simply means that you're not going to accrue any interest on that loan until school is over. The second type, on the other hand, is an unsubsidized loan, which is not based on need. This is a much more common type of Stafford loan, and an unsubsidized loan simply means that the interest on the loan is going to start accruing immediately once you take out that loan. And even though you don't necessarily have to make any payments on it, it'll continue to accrue while your student is in school. Rates on these loans are subject to change and will usually change annually on July 1st. It's important to note also that for a Stafford loan, the amount that your student can borrow is fixed each year. Whenever you see the time to plan icon in the bottom left-hand corner of my videos, that is to draw your attention to a part of the college planning process that's oftentimes overlooked, but where, if done properly, families can save thousands of dollars on their overall cost of college. So for example, with Stafford loans, understanding those fixed amounts each year and how those amounts fit into the resources that are available overall for your family and what they're able to afford on college is a huge opportunity to make sure that you're coordinating those resources and that everything is going as far as it needs to go. I can't tell you how many families we've spoken with through the years that didn't have a plan in place ahead of time, and they didn't understand the way that these loans worked, and they planned on being able to use their full allotment of loans in the back half or later years of college, and unfortunately got to that point where they had burned through all of their other resources, only to find out that the amounts that their student was going to have available to them was fixed in those later years, and all of a sudden they were scrambling to have to find other sources of funding for college. So we don't want you to be in that same scenario. The second type that we're going to talk about today is what's called the Federal Direct Parent Plus Loan. And again, these loans are not based on need. It's important to note that with Parent Plus loans, not only are you going to pay interest on the amount of money that you borrow, but for each Parent Plus loan that's taken out, you're going to pay an initiation fee for that as well. So from an overall cost standpoint, that's part of what you want to compare. Ultimately, this is a parent loan, not a student loan, and the amount that can be borrowed is essentially the full amount up to the cost of attendance at that particular school. So in theory, if a school cost $40,000 and they were not offering any other financial aid, and as a family you were not bringing any other resources to the table, a Parent Plus loan would give the parent the option to be able to borrow that full $40,000. It's also important to note that these loans are not transferable to the student. A lot of parents will sign up for these loans thinking to themselves that once their student is done with school, they have a job and some income coming in, that they can simply transfer those loans over to their student and then be free and clear of them. But that's not the way it works. So another planning opportunity when it comes to Parent Plus loans is to mind the gap. And what I mean by that is understanding what your family's overall funding gap is, not only for the first year of college, but for all 4 years of college, is a critical component of a comprehensive funding plan for school and is key to understanding whether or not a Parent Plus loan might be a good fit for your family. Make sure to check out my other video where I cover 4 key points that parents need to be aware of in terms of understanding Parent Plus loans and how to make sure that they're not signing up for them in the wrong situations. The last type of student loan that we're going to cover today are private student loans. And again, private student loans are not going to be based on the family or student's financial need at a particular school, but rather they're going to be based on more traditional metrics that are used by financial institutions when determining whether or not to loan out money. Most private student loans you can find either some type of fixed or variable interest rate. There's been a real explosion of private student loans as the costs of college have continued to increase. And this has created a lot of buying opportunities for families to really look at and compare different options. Most of the time, student loans are going to be offered again by banks and credit unions, more traditional financial institutions. And again, those loans can be borrowed either by the parents or they can be borrowed by the students as well. If your student is going to be the one signing up for the loan, then more often than not, a co-signer is going to be required because your student otherwise wouldn't be able to get that loan without any type of income. In addition, the most competitive rates you're going to find out there are going to be when the parent is involved either by taking out the loan themselves or as a co-signer in some way. A key component of any comprehensive college funding plan is going to be understanding your school selection so that you can develop a smart lending strategy and make sure that you take advantage of the right types of loans at the right time so that your student can hopefully walk away with as little debt as possible at the end of school. It's one of the key ways that you're going to be able to lower your costs overall, and in which we work with families to help them really understand on a year-by-year basis what is going to be required from a loan standpoint and what that funding gap is. If you're interested in becoming a client and learning how we can help you develop a smart lending strategy to minimize your student loans, please make sure to click the Become a Client link in the video description below. If you have any horror stories about student loan issues or questions about the content I cover in today's video, please make sure to provide it in the comments section below. If you're interested in more tips and videos to help you master the college funding process, please make sure to like this video and subscribe to my channel by clicking the buttons below. Thank you and good luck going beyond the 529.